Hello everyone, myself Deepak Gupta, and today we will take up sales variances topic from the standard costing and variance analysis chapter. And to continue with that, we have already discussed about direct material variances, direct labor variances, and total overhead variances, primarily the fixed overheads. And here the formulas showed that the difference between what should have been the cost, that is the standard cost, and not the budgeted cost, was put up compared against the actual cost. So here the difference was between the standard cost. So standard cost was actually the cost of actual output as per the budgeted methods. So you must have noticed that in all these kind of variances questions which you can find on our YouTube channel taken earlier. So what you have noticed, or if you see again, then you will notice that in all these cases there was budgeted output, and based on that budgeted output, there was the budgeted cost. And then when the period actually produced the goods, there was actual output which normally was not equal to what was budgeted. And hence, obviously, the budgeted cost was bound to change. And that is why we had this figure of actual cost. So both the variants changed. But if we compare this budgeted cost with the actual cost, then it is not good. It is not practical because cost is bound to change with the output because primarily the cost is variable. Therefore, we adapted the budgeted cost for the actual output to arrive at the figure of standard cost, and the difference of standard cost and actual cost showed various cost variances. Secondly, we had to study the impact of such variances on the profitability. Therefore, if the cost could have increased, that is, if the actual cost was more than the standard cost, then it was having a negative effect on profit. So, therefore, when we created that formula, then we always showed as the difference of standard cost and the actual cost by putting the standard cost first. And in this way, if this figure comes out to be positive, then we could easily say that such variances are positive. And if this figure comes out to be negative, it means the actual cost is more than the standard cost. It means they are having a negative effect on the profit. And hence, all the variances were depicted as negative. So in all these variances, we either showed it as negative or we either showed it as positive. We called the negative as the adverse because they were having a adverse impact on the profit, and they were known as favorable because they were having a positive or favorable impact on the profitability. But now we are moving in the arena of sales. Now sales is revenue which is opposite to the cost, obviously. So there will be two changes in all these two factors. That firstly will be a concept of budgeted and the actual. Like earlier, it was budgeted quantity and actual quantity, and budgeted sales and the actual sales. But here, there will not be any concept of the standard sales because there's nothing like standard sales. The only thing can be what you planned to sell and what you actually sold. So the difference of the budgeted and the standard will be the sales variances. That is, there is no concept of standard sales, or we can say that the standard sales or the budgeted sales are similar. So we will only show the concept of budgeted sales, and if some books show standard sales, then that is synonymous. Then that is synonymous with the budgeted sales. Secondly, because now the actual sales, if more than the budgeted sales, then it will have a positive effect on the profit. So conceptually, the difference between the two should be the variance, but because if sales is behaving obviously opposite to the cost, therefore the variances which were earlier negative that is they were showing to be having an adverse impact on the profitability will now show a favorable impact of the profitability. So we can show the formula adversely. That is, instead of writing the formula like standard cost minus actual cost, we will try to show them oppositely like the actual sales minus budgeted sales. So if this is positive, it means the actual sales is more than positive, so it will have a favorable impact on the profit and vice versa. And vice versa. Just a moment. So what will happen now that whenever we will calculate the sales variances, so there will be a concept of total sales value variance, or normally known as total sales variance, which will be showed by TSV or TSVV, and it will be because of primarily two reasons, that is total sales quantity variance and total sales price variance. So normally this quantity is shown as volume. So we show the figure not as quantity variance but as volume variance. So this is value, and because there can be confusion regarding V here and V here, that is why normally we avoid the word value from here and we only show that total sales variance. So it will come as a total sales volume variance. Now, this is just a depiction. Different books can show different words. So, there is nothing like to worry. It is only about the concept. And that will be the total sales price variance. And like in the earlier cases, these three variances will be there only if we have only one product. That is, the business is involved in the sale of only one product. If we are involved in the sale of only one product, then we will have three variances. But if there is more than one product, then in addition to the above three variances, we will have two new variances. That is, the volume variance will be further subdivided as total sales sub quantity variance and total sales mix variance. So this will be total sales mix variance, and this will be total sales sub quantity variance. That is, the variance which was known as yield will be known as a sub quantity variance here. And why this word sub quantity? Because in with cost we can have the word output which denotes the efficiency of the raw material or the labor consumed, and that is not related to the sales. That is why the word has been put to use as sub quantity. So in the case of material, labor or other cost variances, we were at the option to use the word yield variance or sub quantity variance, but yield variance looks better, and here the word sub quantity looks better. So it is just about the kind of word that you are going to use. So we will always say that the total sales variance will be equal to total sales volume variance plus total sales price variance. And the total sales volume variance will be equal to total sales subquantity variance plus total sales mix variance. And that is how we can prove it, though there is no requirement to show that proof, because only question that is asked is how these variances are calculated. So if we now come to the formula, then the total sales variance, that is TSV, will be the difference of the actual sales and the budgeted sales. Ideally, it will be actual quantity multiplied by the actual price, and this will be budgeted quantity multiplied by the budgeted price. Now, if we come to the two constituents, that is the total sales volume variance. So, as the name suggests, this variance justifies or measures the impact of the difference in quantity on the total value of variance. So this total sales volume variance will be equal to the difference in the quantity, that is actual quantity minus budgeted quantity, as multiplied by the budgeted price. Just for no confusion, I'm writing AQ denotes actual quantity sold, AP sold, actual price, yeah, actual sale price per unit, obviously, because sale price is always per unit. BQ denotes the budgeted quantity, that is the quantity to be sold, and budgeted price is obviously the budgeted sale price per unit. So here, this total sales price variance will show the impact of the difference in price for the actual quantity. So the total sale price variance will be equal to the difference in the price, that is the actual price minus budgeted price, as multiplied by the actual quantity sold. Now, these three variances will be calculated whether there are one product sold or multiple products sold. But if there are multiple products, then the recurring problem, as discussed earlier, will be the proportion of the quantity sold, because different quantities will have different price, and there may be a change in the proportionate quantity. There can be a budgeted proportion, and there can be the actual proportion. That is what you plan. If you say that there were three products A, B, C, and you planned them to be sold in the ratio 2:1:1, but the actual sale was 3:1:1. So the ratio have changed. The ratio have changed from 50%, 25%, 25% to 60%, 20%, 20%. And this may have a positive as well as a negative impact on the profitability, depending upon that the quantity of which product has increased, whether it is increase in the quantity of an expensive product, or it is an increase in the quantity of a less priced product. So that is why, to measure the impact of such change in proportion, we also measure the total sales sub quantity variance and total sales mix variance. And therefore, to calculate this, we also calculate RSQ, that is revised standard quantity, which by concept denotes the, and when we use the word RSQ, we can also use the word RBQ, because as I said earlier, in the case of the sales, whatever is budgeted is presumed to be the standard. So therefore, it can be revised standard quantity, or it can be revised budgeted quantity. It can be revised budgeted quantity. So what will happen here, that the budgeted quantity of the product to be considered divided by the total budgeted quantity, this will show the standard proportion or the budgeted proportion, and multiplied by the total actual quantity, that will be what you call the revised budgeted quantity. So the budgeted quantity of each product divided by the total budgeted quantity. फॉर एग्जाम्पल, अगर आपके प्रोडक्ट ए और बी और सी की 5 यूनिट थी, 3 थी और 2 थी बजट में, so 5 divided by 10, so here 10 will show the total budgeted quantity. that 5 by 10 is 50%. So basically this shows the standard proportion. So I can say that this figure shows the budgeted proportion of specific product. जिस प्रोडक्ट की क्वांटिटी ले रहे हो उस प्रोडक्ट का स्पेसिफिक budgeted proportion शो कर रहा है. Okay, so in both these cases we will multiply the budgeted price with the difference. So here it will be the difference of actual quantity with the revised standard quantity, and in this case it will be the difference of revised standard quantity with the budgeted quantity. Okay, so I can just write it again. So it is the difference of the revised standard quantity with the budgeted quantity, and it is the difference of the revised standard quantity with the actual quantity. So with the help of these formulas, we can calculate various sales variances. Now I will try to justify this concept with the help of an example as shown in the beginning of the sheet. So you first take a look at the question that from the following information you are required to calculate the 5 variances of sales, that is sales variance, price variance, volume variance, mix variance and sales quantity variance. It shows 3 products, that is product A, B, C. It means that it shows that we will it shows that we will calculate 5 variances because it has 3 products. So this is the budget quantity or the standard quantity. This is the standard rate, and these two show the actual figures. So the standard and the budgeted are one and the same thing. So I will try to summarize this in the form of a table. This is the data where we have the product A, product B, product C. Please note that if you are able to derive this table from the given data, then with the help of this table only we will be able to solve all the questions as we have done it in our earlier sessions on other variances. So we will have this budgeted data where we have the BQ, where we have the BP, and on the basis of that we can calculate the RBQ or the RSQ. Then we will have the actual data where we will have the actual quantity and the actual price. One more thing that can be added here is that the multiplication of the two will give the figure of budgeted sales, and then we will calculate RBQ, and also we will have the figure of actual sales. So if you see the above scenario, the product and the ratio 5 is to 5,000, 4,000, 3,000 at the rate 567. So the budgeted data is 5,000 units, 4,000 units and 3,000 units in the ratio of budget price of rupees 5, rupees 6, rupees 7. So this figure of 12,000 denotes total budgeted quantity, and therefore this say shows 25,000 rupees, 24,000 rupees and 21,000 rupees. So this figure, if you arrive at that, this will be 45. So this figure of 75,000 will be total budgeted sales. Now we will arrive at the actual quantity. The actual quantity is 654,658. So this is 6,000, 5,000 and 4,000 at the rate rupees 6, at the rate rupees 5 and at the rate rupees 8. So this shows the total actual quantity, and this multiply 36,000, 25,000, and 32,000. This denote the total actual sales, and the figure that comes out to be is 93,000. And based on this, where BQ upon TBQ multiplied by the total actual quantity, so you can calculate easily that 5, this will be 5,000 divided by 12,000 into 15,000. This will be 4 upon 12 into 15,000. And this will be 3 upon 12 into 15,000. If you arrive at that, this will be 5,000. This will be 3750. And if you correctly calculate it, then it will be 6250. And if you add them, then they are coming to be the same figure of 15,000. It is just the actual quantity in standard proportion. So if you will see here, then the total sales variance will be, just to show that plus minus rightly, will be the difference of actual sales minus budgeted sales. If you see this table, now you don't have to go again and again on the question. This will show directly the answers. So here, the actual sales is 93,000, budgeted sales is 70,000. So this 23,000 favorable is the total sales variance. So that is the first variance to be calculated. Now, if we arrive at the total sales volume variance, then it will be actual quantity divided by budget quantity, and the total multiplied by the budgeted price. So the budgeted price, now this will be calculated separately for product A, product B, and product C. For all the three, it will be calculated separately. So the budgeted price was 5 for A, 6 for B, and 7 for C. The actual quantity will be 6,000, it will be 5,000, it will be 4,000, and the budgeted quantity will be 5,000, it will be 4,000, and it will be 3,000. So you will see that actual is more, so this will be 5,000 favorable, it will be 6,000 favorable, and this will be 7,000 favorable. We will have to just a moment. This urgent call. हाँ जी, है। तो कहाँ जा रहे पहले आप? अच्छा। अच्छा मैं, अच्छा अच्छा, पापा नहीं जा रहे? अच्छा 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 अच्छा। ठीक है, ठीक है। Sorry for the disturbance. There were certain urgent call which I had to pick, and if I close the session in between, then it will be stopped. That is why. हाँ जी, so here what will be happening that this total of 18,000, which is very well, because in all the three products the quantity has increased, so this will show the total sales volume variance. Similarly, if we calculate the total sales price variance, then it will be the difference between the actual price and the budgeted price multiplied by the actual quantity sold, and like above, it will be separately for A and B and C. So if you will see that the actual quantity is 6,000 for A, 5,000 for B, and 4,000 for C. And the price was actually, the budgeted price is 567. And if you will see here that the budget price here was 6, 5, and 8, you can check it from the question. You will see here that this is a 6,000 favorable because actual price is more. This is 5,000 adverse because actual price is less than the budget price, and this is 4,000 again favorable. So you will see here that this will come out to be 5,000 favorable, that is total sales price value. You will be able to justify that total sales variance is equal to total sales volume variance plus total sales price variance. That is, this is 5,000 favorable and this is 18,000 favorable, and that will be 23,000 favorable, and that justifies that what we have done is correct. Now, if we arrive at the total sales mix variance and we arrive at the total sales sub quantity variance, in both the cases we will have to calculate separately, and the cases were that you have to multiply the budgeted price with, if you see, it was the difference of AQ minus RSQ, and it was the difference of RSQ minus BQ. But this difference is not important. You can write whatever you want to write earlier because our focus is primarily on the difference. So you will see that the budgeted price is 567. It is 567. The actual quantity, as you have seen earlier, is a 654. That is 6,000. That is 5,000. That is 4,000. Again here, it is a 6,000. It is a 5,000. It is 4,000. And it will be deducted. यहाँ पर इसको मैंने पहले लिख दिया है, चलिए मैं इसको ठीक कर देता हूँ, तो वैसे फर्क नहीं पड़ता. सो यहाँ मुझे बजट क्वांटिटी लिखनी है, तो बजट क्वांटिटी हमारी थी 543. So this is 5,000, this is 4,000 and this is 3,000. अगर आप देखेंगे RSQ तो वो 6250 था, 6250 था, ये 5,000 था, ये 5,000 था, और ये 3750 था. This was 3750. So you will see here that that will be 7250 looks to be adverse. This will be nil, and this will be, if I use a calculator, so this should be 1750 favorable, and it net comes out to be 5,500. And if we show it here, then it will be it looks to be 6250 favorable. This looks to be 6,000 favorable. and this looks to be 5250 favorable, and if we do the total, then it comes out to be 17,500. And I hope that we have now this was a wrong figure because this is 1250 and not. So this will actually be 500. This will actually come out to be 500 favorable. And if you see here that this is also favorable, and if you see here the total is coming out to be 18,000 favorable, so we can say that the direct material volume variance, as said earlier, will be equal to mix variance plus direct, sorry, this is not material, this is sales. Actually, they are all words saying. So the total sales volume variance will be equal to total sales sub quantity variance plus total sales mix variance. So you can check it was 18,000 favorable earlier. This comes out to be 17,500 favorable, and this comes out to be 500 favorable, and it's telling, justifying that our question is correct until and unless there is a contradictory mistake, which is rarely the case. So I hope by using this simple question and the topics which we have discussed earlier, you will be able